U.S. Federal Reserve has delivered perhaps its strongest message yet that not only are rate hikes finished, we may see several cuts next year. While that has set off a rally in the markets, the Fed isn't the only issue that investors need to be focused on. Joining us now to discuss what he sees ahead is Brad Simpson, Chief Wealth Strategist at TD Wealth. Brad, great to have you with us as always. Lots of stuff to get through and an excited market based off of the Fed. Where do you want to begin with all this? There's lots to plow through.
How many times have you said Fed in the first couple of minutes? I know that's always our starting point.
Start the end of the year where we started the year, with the Fed.
With the Fed, yeah. And then the Fed said, well, Greg, it's good to be here, by the way. Thanks so much for having me. Look, I guess we're going to have to start. I think we really are going to have to start with the Fed, and I think the reason for this is even, your introduction reminded me a little bit of years ago. There was a Steve Martin movie called L.A. Story, where he's a weather forecaster. Basically, come on air, and all they do is throw sunshine up on the screen. It's sunny, it's sunny, it's sunny, it's sunny. And and a little bit when you look at how markets are, they're very much both. You can look at either fixed income or equity, and it's sunny, and you can get, and that's indeed, and a lot of that is that. So if there's something we've said more than the Fed over the last years, we've used the word inflation, and a lot of that's been the driver of either upside or downside for fixed income and equity markets for much of the last couple of years. And there's increasing signs clearly that great progress is being made, and I think maybe that's the starting point. If you kind of look through Powell's comments, he over and over again, he used the words very good and really good, and when he was talking about inflation and the progress that was being made there. And that I think alone tells you an awful lot of that. Then he kind of went through this process and talked about, look, we had this if we go at the beginning of the year, the supply side really did surprise on the upside and allowed the economy to expand a lot faster while inflation was cooling. And so, they've kind of even started to frame that story out. So, the last one is, I think, kind of maybe it's what he didn't say as well. I think if we went back and looked at a tape from when you and I met in the summer, one of the things that we were talking about there is looking at financial conditions index. And back in August of last year, when the financial index was softening, I mean, boy, they absolutely went, wait a minute, that's not what we want here. We want the opposite. And they've really consistently, since about the summer of last year till now, just over and over said, let's look at these financial conditions. We're going to see them, loosen them, and we're going to tighten them up. Well, if you look at financial conditions index in the last couple of months here, they're starting to trade like it's 2008, 2009, like at the beginning of a loosening cycle where you want to get things going again. And clearly we're not there. We're at the end of 2023, where we've done everything we could to tighten things up, to slow things down, and there was no concern about how loose how loose some of these financial condition index are looking right now. So, good, really good, and not concerned about loose financial conditions gives you a really good idea of what his comments were. So I think officially he's basically coming out and saying, listen, we're not satisfied with inflation. We've got more to go. But kind of unofficially, they kind of think that inflation is a real close to their kind of 2% target rate that they're looking towards. They're feeling pretty good about things, and the market is kind of, both fixed income and equity markets are trading off of that.
Now you have a chart to show us, Brad, because there is an old saying, right, that the last mile can be the hardest mile. Talking about the fact that getting actually back, we've made great progress, but getting back to 2, where you want to be, could be a bit of a slog.
Yeah, and I think that's one. So for clarity on this, we kind of have this giddiness of the moment, but I think at the end of the day, there still is this process that we need to go through. Rents, they are looking a lot better. We saw a little bit of move upwards on the CPI numbers, where that the used car prices were starting to move upwards, but that's probably a temporary thing as well. Rents are still a concern, and so that we're going to be publishing either today or tomorrow our year ahead document, and that's where this chart is from, and as well as we're feeling good about all this stuff. Any sign, anything that says that there could be a reversal in an inflation, that you're going to see, you could see things tighten up very, very quickly. And I think while we're feeling good about things, I think we're not at a place where you're declaring victory yet, and that's really all the point we were trying to make there. And I think we better continue to be able to making sure that we're pretty diligent.
What could that mean then for investors? I mean, we take the win for now, and the markets are rallying, and yields are falling, and you're feeling a bit better about the situation. But could this mean just more volatility in equities? As you said, if the fight against inflation isn't over yet, there's going to be a bit of a slog, a bit of a bumpy ride on the equity side.
Well, I mean, first of all, if right now what we're seeing right now is this is a really, in the short term anyways, a really pro risk environment, and also really, and so that's why you're seeing these kind of equity assets really start to rally here, and a much broader based rally. And it's good news. It's obviously good news for yields and for fixed income returns in the short term as well, which is why we've seen the move that we've seen there. And it also, typically when this is also means that you should have a lower U.S. dollar, and that's what we're seeing as well. So in the short term, undoubtedly there is that. Now, I would say an awful lot of our discussion so far today has been short term, and that this will start to evolve and change, and I think we have to start thinking about, okay, where are we going to go from there, right? Let's enjoy the moment, but let's start framing out where we are next. So, I think to your point, one of the things that if you think about all the remarkable things and difficult things that we've gone through in 2023, there's been absolutely almost no equity volatility whatsoever. And so, again, one of the things that we think as we start moving into 2024, that one thing that we might want to be mindful of is that this lack of volatility is probably going to start moving away. We'll probably see it more of it as we move forward. You're getting at a pricing part now where an awful lot of the good news, any good news you want to find, is increasingly getting closer to being priced in. And so that if you think about some of the other things we're going to have to work our way through, that we should see some more equity volatility as we move forward.
If we think about volatility, some investors see it as opportunity as well. But the old saying again too, you got to have a sharp pencil. Is it going to be that kind of 2024 where you really got to pick your spots?
Yeah, well, that's, I think, an interesting way of looking at that is I think it's been well documented that in 2023 it was, you had to pick the spot, right? And until really October, this was very much a one-story market we had, and we've belabored that to death, which is the Mag 7. And I think that the good news is since October we've seen such a pretty broad-based rally both in equity markets. And if you look at that spread of, like, if you take the S&P 500 and look at the difference in return, even still kind of year to date, and you look at how much of that return has been through that big group of 7, and then how much the other side has lagged, and then if you kind of look over at the Russell 2000 just to get a kind of a broader scope on what the kind of that baseline small cap company has done, the return has still been very low there. So I think that picking your spots, it might be, is ways of looking at it, is that as we are moving forward in 2024, is that there's probably going to be a market where you can be invested in more spots, and if you're invested in more spots, that's going to be more beneficial for you based on rate of returns. It's also going to mean that it'll be better for folks who are running diversified investment portfolios, which, quite frankly, have up until again this October when things really started to rally. And I got to admit, we're pretty pleased about this rally. I guess one of the things you and I've talked an awful lot about is that you can't set your calendar by it or set your watch by it, but there's all things pointing to, especially on the fixed income side, that you would see that rally start to kick in, and indeed it has. And so I think that I think that you could look at 2024 is going to be a market where the people who are running diversified investment portfolios and are going to be really happy that they did, and I think that's going to be a good year for that.